Hello, everyone. My name is Anand Manikutty, and it's a pleasure to speak with you today. This session was prepared especially for IIT Madras. I was invited to give a guest lecture at IIT Madras, and this session was prepared especially for them. Today, we're going to talk about one of the simplest and most powerful tools in strategy. This is the BCG Matrix. Before we dive in, let me set the tone with a small analogy. Sometimes strategy feels a little like a Bond movie, like a James Bond movie. You have limited agents, limited gadgets, and limited missions. What matters is where you deploy them and when. Now, companies, that is, corporations out in the wider world, face exactly the same challenge. They also have limited resources. They also have limited budgets, time, products, etc. And so the central question is, where should we invest? Where should we divest? And where should we simply hold our positions? This is where the BCG matrix comes in. It's very simple to draw, but once you understand it, it can explain a surprising number of decisions that companies make. Even if newer models are more complex, just the BCG matrix model can help identify the rationale behind the thinking. So let's take it step by step and build it up piece by piece. Part one, why the BCG matrix exists. Let's consider that. Why does the BCG matrix exist? First, a little context. Back in the 1970s, a consulting firm called the Boston Consulting Group noticed a pattern. Companies which had many different products often didn't know where to invest their time, money, and energy. So BCG created a simple picture to help managers decide. Such things that were required for this decision-making processes included: number one, what should we grow? Number two, what should we maintain? Number three, what should we experiment with? And number four, what should we quietly retire? And that picture is called the BCG matrix. So if you keep that purpose in mind, that is, helping managers decide what they should grow, what they should maintain, what they should experiment with, and what they should quietly retire, the whole model becomes much easier to understand. So let's go to part two. So the BCG matrix, let's take a look at the matrix. The matrix has two axes. So let us call this part the two axes. Part two, the two axes. So let us look at the basic layout. The matrix has two axes, X and Y. That is X and Y, like this. And axis one is the market growth rate, the y-axis. And the axis two is the relative market share. That's the x-axis. So axis one, the market growth rate axis, this tells you how fast the overall market is growing. So a fast growing market is like a rising tide. It lifts everyone up. And axis two is relative market share. This axis tells you whether you're a leader or a smaller player compared to your biggest competitor. That's it. Fast growth versus slow growth, high market share versus low market share. Fast growth versus slow growth, high market share versus low market share. Everything else comes from this. So now let's move to the third part. Let us call this the four quadrants. Part three, the four quadrants. Please feel free to pause the video if you need to take a break, or if you just want want to catch up on understanding all that I've conveyed here? All right, so let's move on now. Part 3, the 4 quadrants. So now when you combine fast growth and slow growth with high share and low share, you get 4 types of businesses, and we'll go through them one by one. So we have these 4 quadrants, and therefore we have these 4 different types of businesses. So high, this is the stars. So first I'll give the essence of each, and only after that we'll add examples. So let's start with the stars. Number 1, the stars. High growth, high market share. So stars live in fast growing markets and they are leaders in those markets. They need investments to keep their lead, but they also can become the company's future profit engines. So one sentence memory, a star is your future cash cow. Okay, one sentence one sentence mnemonic, a star is your future cash cow. Number 2, cash cows, low growth but high market share. These are the businesses that dominate a stable market. They don't grow much, but they generate steady, reliable profits. You could even say some of these businesses would be considered boring businesses. They just generate steady profits all the time. So one sentence mnemonic, a cash cow funds everything else. Often cash cows produce a lot of cash and you can use them to fund whatever else you want. Then come question marks, high growth, low market share. Now question marks live in booming markets, but the company is not yet a leader. They require investment, experimentation, and smart decisions. Some become stars, but the truth is many fail and become dogs. So the memory, one sentence memory here. A question mark is a bet, high risk and high potential. Then come the dogs, low growth, low market share. These are products of businesses that don't grow and don't lead. They're necessarily bad, but they don't usually deserve major investment. So one sentence memory here would be, one sentence mnemonic would be, here would be, a dog is for maintenance or divestment. That takes us to part 4, the examples. So part 4, the examples. So now let me add a few simple modern examples you can use to anchor these ideas. Again, we'll keep it light, just 1 per quadrant. Stars. An example of a star would be Tesla's EV business in the early 2020s. Fast market growth, strong leadership position. Cash cows, Microsoft Windows and Microsoft Office. The best examples. Mature market, steady dominance. Question marks, AI search tools like Perplexity, fast growing space but still fighting for leadership. And then the dogs, Yahoo Mail, for instance, stable or declining market and limited share. These 4 examples alone are enough to cement the model. I'll come back to do the other parts in the next video. Thanks for listening.